Let me tell you about something that keeps me awake at night. It's not a question of if anymore, it's a question of when. We're watching one of the largest financial experiments in human history unfold in real time, and most people don't even realize it's happening. The United States Treasury needed to find buyers for over $10 trillion in government bonds in 2024 alone. That's more than one third of the entire outstanding government debt. But here's what should terrify you. Over the next decade, according to the Congressional Budget Office, the federal government will need to find buyers for $24.5 trillion of debt. $24.5 trillion. Let that sink in for a moment. Now, you might be thinking, well, the U.S. has always found buyers for its debt. Why should this time be different? And that's exactly what I want to talk about today. Because this time, it actually is different, and the data is screaming at us if we're willing to listen. Let's start with who's been buying U.S. debt and what's changing. For decades, foreign governments, particularly China and Japan, were the backbone of demand for Treasury securities. They had strong incentives to hold dollars. They needed dollar reserves for trade. They wanted to keep their currencies competitive. And frankly, there wasn't a better alternative. But that world is ending. China's holdings of U.S. Treasury bonds fell to $759 billion in December 2024. That was the ninth consecutive month of declines that year. Now, China's peak holdings were above $1 trillion. They've been systematically reducing their exposure, diversifying into assets like gold. And before you say this is just about geopolitics or U.S. China tensions, let me be clear. This is also about cold, hard financial calculation. China is managing its foreign exchange reserves like any rational actor would when they see risk on the horizon. Japan's story is even more dramatic. Japanese investors sold a record $61.9 billion of Treasury securities in just 3 months, ending September 30th, 2024. $62 billion in 3 months. Part of this was currency intervention, yes, but there's something deeper happening. The Japanese government bond market, which for decades offered virtually zero returns, has transformed. 30-year Japanese government bond yields are now above 2.5%. When Japanese investors can get decent yields at home without currency risk, why would they lock up money in U.S. Treasuries that, after hedging currency exposure, offer limited additional return? Here's the broader picture that should alarm you. Foreign investors' share of U.S. Treasury holdings has collapsed from over 50% during the global financial crisis to about 30% as of early 2025. But it's not just the decline in quantity, it's the change in quality. The buyers who are leaving are the pricing sensitive ones. The central banks who bought treasuries for strategic reserves regardless of price. The buyers who remain are increasingly price sensitive private investors who will demand higher yields if they perceive more risk. This structural shift increases market volatility and fundamentally changes the dynamics of Treasury auctions. Let me walk you through what we're seeing at these auctions, because this is where theory meets reality. In May 2025, a 20-year Treasury bond auction saw investors accept a yield of 5.047%. That was the first time the yield crossed above 5% since October 2023. The bid-to-cover ratio, which measures how much demand there is relative to the supply being offered, has been slipping in several recent auctions. Primary dealers, the banks required to buy whatever doesn't sell, have been drawn on more heavily. They're becoming the buyer of last resort more frequently. Now, some analysts will tell you, look, the auctions are still completing, there's no crisis, and technically they're right, but they're missing the point. It's like saying the Titanic was fine because it was still floating even as water poured into the hull. The question isn't whether we can still sell debt today. The question is at what price and for how much longer. Let's talk about what happened in May 2025 that should have been front page news everywhere, but somehow got buried in the news cycle. Moody's, the last of the three major credit rating agencies to hold the United States at the top AAA rating, downgraded the U.S. sovereign credit rating to AA1. This wasn't some fly by night rating agency, this was Moody's, and they were the last holdout. Standard & Poor's downgraded the U.S. back in 2011. Fitch followed in 2023. Now, all three have said the same thing. The United States is no longer a risk-free borrower. Why did Moody's do this? Their assessment was devastating. They projected that U.S. federal debt could reach 134% of GDP by 2035, up from 98% in 2024. They're expecting persistent budget deficits of around 7% of GDP annually. 7% year after year after year. That's not a budget deficit. That's a structural inability to live within our means. The numbers from the Government Accountability Office are even more sobering. They project that publicly held debt will reach 200% of GDP by 2047. 200%. We're not talking about some distant theoretical problem. We're talking about a trajectory that, if unchanged, will fundamentally transform what it means to be the United States government. In fiscal year 2024, the government spent $882 billion just on net interest payments. That's more than was spent on national defense, more than Medicare, just the interest on the debt. And that number has more than tripled since 2017. Think about that. We're not even paying down the principal. We're just servicing the interest, and it's already consuming resources that would otherwise go to military readiness, healthcare, infrastructure, education. The Congressional Budget Office projects that federal debt held by the public will climb to 107% of GDP by 2029. That will exceed the historical peak reached immediately after World War II. But here's the difference. After World War II, we had a rapidly growing economy, a young population, global dominance in manufacturing, and we paid that debt down. Today, we have slower growth, an aging population, and we're adding debt faster than ever. Now, I want to address the elephant in the room. Some of you are thinking, but the dollar is still the global reserve currency. That gives us special privileges. We can print our own money. This debt is all denominated in dollars. We can never truly default. And you're right in a narrow technical sense, but you're missing what actually happens when confidence erodes. Yes, we can print dollars to pay our debts, but every dollar we print dilutes the value of every other dollar in existence. That's not defaulting in the traditional sense, but it's defaulting on the purchasing power that bondholders expected. And here's the thing about confidence. It's like virginity. Once you lose it, you can't get it back. When investors start to question whether they'll be repaid in dollars that have the same purchasing power they expected, they demand higher interest rates to compensate for that risk. Those higher interest rates increase the government's borrowing costs, which increases the deficit, which requires more borrowing, which further erodes confidence. It's a vicious cycle. The dollar's share in foreign exchange reserves has already declined from over 70% in 2000 to just under 60% today. Now, 60% is still dominant, and I'm not predicting the imminent collapse of the dollar. But the trend is clear. Central banks around the world are diversifying. Emerging market central banks have doubled their gold holdings from 4% of reserves a decade ago to 9% today. They're buying gold not because they think it will give them great returns, but because they're worried about the alternatives. What's fascinating is that this diversification away from the dollar accelerated, then plateaued. The dollar share has been basically stable since 2022 at about 58%. Some analysts pointed out that even after the U.S. sanctioned Russia and froze its dollar reserves following the invasion of Ukraine, we didn't see a massive flight from the dollar. And that tells you something important. Despite all the problems I'm describing, despite all the warning signs, there is still no viable alternative to the dollar as a global reserve currency. The euro has its own debt problems and political fragmentation. The yuan is not freely convertible, and China's capital controls make it unsuitable as a reserve currency. Cryptocurrencies are too volatile and lack the depth and institutional support. So we're in this strange situation where everyone knows the dollar's position is unsustainable in the long run, but nobody can move away from it because there's nowhere else to go. It's like we're all on a ship that's taking on water, but all the lifeboats are leaky too, so we stay on the main ship even though we know it's sinking slower than it should be sailing. This is what I call the no good options equilibrium. And it can persist for longer than you might think, much longer. But equilibriums based on the absence of alternatives rather than positive fundamentals are inherently fragile. They can break suddenly and without warning when circumstances change. Let me paint you a picture of how this could unravel. It won't be dramatic at first. There won't be a single day where Treasury auctions fail and the government can't borrow. Instead, it will be a slow grinding process. Yields will gradually rise. The government will pay more and more in interest. That will crowd out other spending or force tax increases or both. Economic growth will slow because higher interest rates make borrowing more expensive for businesses and consumers. Slower growth means less tax revenue, which means larger deficits, which means more borrowing, which means higher yields. Round and round we go. At some point, maybe at 120% of debt to GDP, maybe at 150%, maybe at 180%, we'll hit what economists call a fiscal crisis. The Congressional Budget Office defines this as a situation in which investors lose confidence in the value of the U.S. government's debt, causing interest rates to rise abruptly. When that happens, financial institutions holding large amounts of government debt could fail. Banks, pension funds, insurance companies, they all hold treasuries as safe assets. If those assets suddenly lose value because interest rates spike, we could see a cascade of failures through the financial system. And here's the truly scary part. We don't know where that breaking point is. It's not written in stone that it happens at 150% debt to GDP or 200%. Japan has debt over 250% of GDP and hasn't collapsed, but Japan is different. It has a massive domestic savings pool, a current account surplus, and most of its debt is held domestically. The U.S. is different. We run persistent trade deficits, we have lower savings rates, and we're more dependent on foreign buyers who can leave if they lose confidence. Some economists argue that as long as GDP grows faster than the interest rate on the debt is sustainable. But look at the numbers. Real GDP growth in the U.S. has averaged around 2 to 2.5% in recent years. The interest rate on 10-year treasuries is now regularly above 4%. Even if you assume some inflation brings the real rate down, we're in a situation where the interest rate is exceeding the growth rate. That means the debt to GDP ratio will keep rising unless we run primary budget surpluses, which means our revenue exceeds our spending before interest payments. And we're nowhere close to that. We're running primary deficits of several percentage points of GDP. Let me address another argument you'll hear, that government debt isn't like household debt, that the government can always roll over its debt, issuing new bonds to pay off old bonds as they mature. This is true as long as people are willing to buy those new bonds. But what happens when they're not? Or what happens when they're only willing to buy them at much higher interest rates? The entire edifice depends on confidence, on the belief that the U.S. government will always be able to pay its debts and that the dollar will retain its value. Once that confidence cracks, everything changes very quickly. Now, let me be clear about something. I'm not predicting that this crisis will happen next month or next year. The U.S. has extraordinary advantages. We have the deepest and most liquid financial markets in the world. We have strong institutions, the rule of law, property rights. We have a diversified economy and tremendous innovative capacity. The dollar is used in the majority of international transactions. All of these things buy us time. They allow us to sustain debt levels that would have crushed other countries years ago. But time is not infinite, and we're not using the time we have to fix the problem. If anything, we're making it worse. Every year, the debt grows. Every year, interest payments consume more of the budget. Every year, the demographics get worse as baby boomers retire and start collecting Social Security and Medicare. Every year, we drift closer to the edge of the cliff. What would it take to fix this? Mathematically, it's simple. We need to run budget surpluses, or at least get close to balance. That means some combination of spending cuts and tax increases. The problem is that it's politically impossible. Cut Social Security, political suicide. Cut Medicare, political suicide. Cut defense spending significantly, good luck getting that through Congress. Raise taxes substantially, also political suicide. We've created a political system where both parties promise voters that they can have all the government services they want without paying for them, and then they blame each other when the debt goes up. The longer we wait, the harder it gets. If we had started dealing with this 20 years ago, the adjustments needed would have been modest. Today, they're painful. 10 years from now, they might be catastrophic. Eventually, we'll either choose to fix it through deliberate policy changes, or the market will force it upon us through a crisis. And believe me, you want the former, not the latter. Policy changes, even painful ones, can be phased in gradually, can include protections for the most vulnerable, can be designed to minimize economic disruption. A market-imposed solution means a sudden stop in borrowing, emergency austerity, financial panic, potential bank failures, and economic collapse. It's the difference between controlled demolition and an uncontrolled implosion. Here's what keeps me up at night. I look at the trajectory we're on, and I see a collision course with fiscal reality. But I also see a political system that seems incapable of making the hard choices necessary to avoid it. I see both political parties engaging in what I can only describe as magical thinking. I see politicians promising tax cuts and spending increases simultaneously. I see a media environment that rewards outrage and tribalism rather than serious policy discussion. I see an electorate that wants Nordic levels of government services with Texas levels of taxation and gets angry when told that math doesn't work. The base case, the most likely scenario, is that we muddle through for another 5 or 10 or maybe 15 years, accumulating more debt, paying ever higher interest, slowly eroding our fiscal flexibility. Then, at some point, something breaks. Maybe it's a recession that causes tax revenues to plummet while spending on automatic stabilizers soars. Maybe it's a geopolitical crisis that requires massive defense spending. Maybe it's simply that debt to GDP crosses some psychological threshold and foreign buyers collectively decide they've had enough. Whatever the trigger, there will come a day when we try to auction Treasury bonds and there aren't enough buyers at acceptable interest rates. When that day comes, the Federal Reserve will face an impossible choice. They can step in and buy the bonds themselves, essentially printing money to finance the deficit. That risks runaway inflation and destroys the dollar's credibility. Or they can refuse to intervene, let interest rates spike, and watch as the government potentially can't make payments and financial institutions holding treasuries collapse. There is no good option at that point. Both choices lead to economic catastrophe, just different kinds. The optimistic take is that we'll see the warning signs clearly enough and act before we reach that point. That as bond yields rise and auctions become more difficult, the political system will finally wake up and make the hard choices. That we'll see a grand bargain on fiscal policy with serious entitlement reform, tax increases, and spending controls. I hope that's what happens. But hope is not a strategy, and I don't see much evidence that our political institutions are capable of that kind of far-sighted decision-making. What can you do as an individual? Understand that if this scenario unfolds, it will affect you regardless of whether you own Treasury bonds. Higher interest rates affect mortgage rates, car loans, business investment, and stock valuations. A fiscal crisis would likely trigger a severe recession. Inflation could surge if the Fed monetizes the debt. The value of the dollar could plummet, making imports more expensive. Diversification becomes crucial. Don't keep all your assets denominated in dollars. Consider international diversification. Think about real assets that hold value even if currency depreciates. Build resilience into your personal finances. Keep your debt low. Maintain an emergency fund. Invest in skills that will remain valuable even during economic disruption. For policymakers, if any are listening, the message is simple. Deal with this now, while we still have options. Every year of delay makes the problem harder. The demographic wave of baby boomer retirements is already here and will intensify over the next decade. The interest rate environment has already shifted from the ultra-low rates of the past 15 years to something more normal. The fiscal room for maneuver is shrinking rapidly. We need a serious bipartisan commission with real authority to propose comprehensive fiscal reforms. We need to put everything on the table: Social Security, Medicare, defense spending, tax expenditures, the whole budget. We need to phase in changes gradually to give people time to adjust. We need to protect the most vulnerable while ensuring the system remains solvent. Most of all, we need political leaders willing to tell the truth to the American people, that we cannot continue on this path, that hard choices are necessary, and that the sooner we make them, the less painful they'll be. The United States has overcome enormous challenges before. We faced down wars, depressions, and existential threats. We have the resources and capabilities to fix this fiscal crisis if we choose to. The question is whether we have the political will, because make no mistake, this is fundamentally a political problem, not an economic one. We know what needs to be done, we just lack the courage to do it. So when someone asks me, what happens if everyone stops buying U.S. debt? My answer is this: they won't all stop at once, because there's no better alternative. But they will slowly reduce their holdings, demanding higher yields, increasing volatility, and tightening the noose around our fiscal neck. The process will be gradual until suddenly it's not. And on that day, when confidence finally breaks, we'll discover that being the world's reserve currency was a privilege, not a right. And privileges can be lost. The time to act is now, while we still have the luxury of choice. Because if we wait until the market forces our hand, The consequences will be far more severe than any policy adjustment we can make today. The debt crisis is not coming. It's already here. It's just unfolding in slow motion. And slow motion disasters are the most dangerous kind because they lull us into thinking we have more time than we do. The question is not whether this will end badly if we don't change course. The question is whether we'll change course before it ends badly. I wish I knew the answer to that. But based on what I'm seeing, I'm not optimistic. And that terrifies me because when this unravels, it won't just be numbers on a spreadsheet. It will be people's retirement savings, their jobs, their ability to afford basic necessities. It will be real hardship for real people, and it will be entirely preventable if only we had the wisdom to prevent it. Thank you.